When people worry about a sudden currency collapse, they usually picture an overnight, apocalyptic hyperinflation event completely wiping out their savings. There are historical precedents for what an actual fiat death spiral looks like. There are also modern examples where the local currency is treated as literal street trash. The US dollar isn't doing this. Instead, it is experiencing a slow, predictable erosion of purchasing power by design. This chart tracks the US dollar share as the global reserve currency since the 1970s, dropping from 70. Common low-effort moves, like holding foreign currency in fintech apps, offer almost zero true asset protection. Asset Class 1 focuses on stability. Buying physical foreign real estate provides a hard asset that is unpegged from the dollar. In markets like Colombia, real estate can appreciate in dollar terms, while simultaneously serving as a backup residence. The trade-offs are clear. Real estate is illiquid, requires local management, and ties you to a specific localized market. For ultimate offline stability, some investors look to physical gold and silver stored entirely outside the banking system. Utilizing private offshore vaults in jurisdictions like Singapore insulates wealth from domestic political seizure. This involves extreme logistical friction, often requiring private armored transport to move physical assets across borders. While physical offshore assets offer the highest level of geopolitical stability, they demand high initial capital and generate zero liquid yield. If we plot true offshore banking on our framework, it sits in the top right, high friction but high protection. Holding historically stable foreign fiat currencies is a straightforward way to preserve purchasing power as the dollar declines. The Swiss franc is a prime example of a currency managed for stability, typically accessible through European residence permits or trust structures. It is still legally possible for U.S. citizens to open foreign accounts in strong banking hubs to hold these currencies directly. The Singapore dollar is a highly stable alternative, and many Singaporean banks still accept U.S. clients for cash holdings. Establishing foreign accounts for stable fiat preserves your baseline value, but it trades potential high returns for pure capital preservation. Asset Class 2 is asymmetrical growth. This targets emerging markets where the local currency is currently strengthening against the dollar. This chart illustrates the double compounding mechanism. You earn when the foreign stock rises, and again when that country's currency appreciates. This dual return model allows for yields that can outperform standard U.S. market averages simply by operating outside the dollar. One accessible example is buying stocks on the Mexican exchange, where returns are enhanced by the peso's performance. Unlike offshore vaults, these equities can often be purchased through standard domestic brokerage accounts, meaning the friction is low. However, buying foreign equities via a U.S. broker leaves your assets entirely exposed to domestic legal jurisdiction. Asset Class 3 is high-yield fiat. This is for investors looking to earn significant interest rates on cash deposits. In Georgia, for example, holding the local lari in a bank account can yield up to 12% interest. Frontier markets like Ghana offer even higher potential metrics, though their currencies are significantly harder to access. This chart highlights the primary danger of this asset class: currency peg risk. If a government devalues the currency, your yield is erased instantly. There is also the matter of complex tax liabilities. Neighboring countries like Armenia and Georgia treat bank account interest in completely different ways. Frontier yields vastly outperform U.S. Treasuries, but they replace inflation concerns with acute emerging market volatility and tax complexity. Escaping the dollar is a sliding scale of friction. The right move depends entirely on how much wealth you are trying to protect. We can separate the strategy into two distinct profiles based on your resources. If you are a portfolio diversifier, the focus is on low-friction interactive brokerages to buy foreign equities in places like Mexico or Poland. The blind spot here is sovereign privacy. Brokerage diversification is not the same as legal isolation. For the geo-arbitrage optimizer, the strategy shifts to structural isolation through offshore trusts, foreign property, and vaulted physical metals. This requires accepting steep legal setup fees and rigorous compliance reporting to your home country. Access to high-performing offshore banks and regional stock markets is frequently restricted for U.S. passport holders. Having a different nationality allows you to bypass these institutional barriers. Acquiring secondary citizenships provides the legal standing required to enter financial avenues that are otherwise closed to Americans. Higher yields and true asset protection are attainable, but they demand that you treat your wealth like a global institution. Replacing the crumbling US dollar with true stability means consciously choosing to trade domestic convenience for sovereign independence.